Elon Musk is preparing to take SpaceX public at a target valuation of $1.75 trillion. That would make SpaceX worth more than every American defense contractor combined. More than Coca-Cola, McDonald's, Disney, Nike, and Starbucks added together. More than JP Morgan, Walmart, and Berkshire Hathaway combined. And the company lost $5 billion last year. So who exactly is buying SpaceX at the largest IPO valuation in human history? The answer is you. Your retirement account is about to become one of the biggest buyers of SpaceX stock, whether you asked for that or not. Because NASDAQ just rewrote its own listing rules. 3 separate changes, each one removing a specific barrier that would have blocked SpaceX from qualifying. I'm Jimmy, and this is Finance Misfires. Let's break down what's actually going on here, because this story is not about rockets. Before the valuation makes any sense, or doesn't, you need to understand what SpaceX actually is. Because if you ask 10 random people on the street what SpaceX sells, most will say rockets. Some will say Mars stuff. Both answers miss the point entirely. SpaceX is actually 3 distinct businesses operating under one roof, and the rocket business isn't even the most important one. The first business, and the ugliest one, is xAI. Earlier this year, SpaceX acquired xAI, the AI lab Musk founded in 2023 to compete with OpenAI and Anthropic, in an all-stock deal that valued the combined entity at $1.25 trillion, with xAI itself carrying a $250 billion price tag. If you're wondering how it's legally permissible for one of Elon's companies to acquire another one of Elon's companies, honestly, same. But it happened. Here's the problem. xAI was burning more than $1 billion per month by 2025. And by March of this year, every single one of its 11 co-founders, researchers and engineers recruited from DeepMind, OpenAI, Google, and the University of Toronto, had walked out of the company. Musk then publicly acknowledged on his own platform that xAI needed to be rebuilt from the ground up. To put the valuation in context, OpenAI generates around $24 billion in annual revenue, valued at roughly $850 billion. Anthropic generates over $30 billion, valued around $400 billion. xAI, with roughly $1 billion in revenue, was absorbed into SpaceX at $250 billion. The market is pricing xAI like it's Emirates. In reality, it's flying Spirit Airlines with no co-pilots and a burning engine. So if xAI is the ugly part of SpaceX, what are the 2 businesses actually doing the work? The second business is the actual rocket operation, launching satellites for the U.S. government, cargo missions to the International Space Station, crewed flights for NASA, and a growing commercial manifest. The rocket business generated roughly $4 billion in revenue last year, which sounds impressive until you hold it up against a $1.75 trillion valuation. At which point it sounds like a company being valued like it's already colonized Mars when it's still mostly launching things into low Earth orbit. And here's the kicker. That's only about a quarter of SpaceX's total revenue. 3/4 is coming from somewhere else entirely. The third business is the one most people don't think about when they hear the word SpaceX, and it's the one that investors actually care about. It's the one quietly funding everything else. It's Starlink. Starlink is a satellite internet provider. Comcast, but in space. Over 10,000 satellites in orbit beaming broadband down to a self-pointing dish on your roof. Maritime versions for ships. An aviation version rolling out across commercial airlines. A classified defense version called Starshield with active Pentagon contracts. The numbers tell the story directly. Over 10 million active subscribers across roughly 150 countries. $11.4 billion in revenue in 2025, approximately 61% of SpaceX's total profit margins at 41% 2 years ago, now sitting at 63%. 20 points of margin expansion in 24 months. The margins aren't just good, they're accelerating, which means the unit economics are getting stronger the bigger it gets. So here's the honest picture of what SpaceX actually is. A satellite internet provider that prints serious cash, a rocket business performing well, but valued like it's already running a Mars colony. And after the xAI merger, an AI lab burning roughly $1 billion every single month that needs to be rebuilt from the foundation up. In 2025, Starlink and the rocket business combined generated roughly $8 billion in profits. Then XAI showed up to the party and lit it on fire. The consolidated company, SpaceX plus XAI, ended up losing nearly $5 billion on roughly $18.5 billion in total revenue. A company losing $5 billion annually, targeting a $1.75 trillion valuation. The largest IPO in human history. And your retirement account is about to be one of the buyers. Which brings us to the part of this story that actually matters most, and the part that traditional financial media is almost completely ignoring. On May 1st of this year, NASDAQ adopted something called the Fast Entry Rule. With SpaceX reportedly targeting a June IPO date, the timing of this rule change is either the most remarkable coincidence in financial history, or it's exactly what it looks like, the exchange rewriting its own listing requirements, right before the biggest IPO it has ever hosted. Let's walk through exactly what changed, because there were 3 separate rule modifications, and each one removed a specific barrier that would have prevented SpaceX from qualifying under the old system. Change 1. The waiting period. Under the old NASDAQ rules, a newly listed company had to wait a minimum of 3 months before it could be added to the NASDAQ 100 index. That waiting period existed for a deliberate reason. To give the market time to actually discover a fair price before hundreds of billions in passive fund capital was legally required to buy in automatically. The fast entry rule cuts that waiting period from 3 months to 15 trading days. 3 months of price discovery compressed into 3 weeks. Change 2. The free float minimum. The old rules required a company to have at least 10% of its shares freely available for public trading before it could qualify for NASDAQ 100 inclusion. SpaceX is targeting a free float of 4 to 5%. Under the old rules, automatic disqualification. Under the new rules, that minimum requirement is simply gone. Change 3. The hidden float multiplier. This is the one that genuinely broke my brain when I read it. Buried in the technical language of the new rules is a provision that for companies with a free float under 20%, NASDAQ now treats the float as 3 times larger than it actually is for index weighting purposes. A 4% float gets weighted as if it were 12%. A 5% float gets weighted as if it were 15%. In plain English, NASDAQ has engineered manufactured demand. ETFs and index funds, tracking the NASDAQ 100 will now be legally required to treat SpaceX's tiny public float as 3 times its actual size, funneling significantly more automatic buying into the stock than the real float would otherwise justify. The rules didn't bend slightly. They got completely rewritten, and the red carpet got rolled out in 3 distinct coordinated moves. And this is where it lands directly in your life, whether you're paying attention or not. Most IPOs allocate 5 to 10% of the offering to retail investors. SpaceX is targeting 30%. The CFO told a room of Wall Street bankers on the record that retail buyers have been incredibly supportive of Elon, and the company wants to recognize that support. Translated, they want to sell 30% of the largest IPO in history to the buyers least equipped to challenge the price. Portfolio manager George Noble put it directly. Your 401k is the exit liquidity, and he's right. If you hold any U.S. stock index fund, within weeks of the listing you are going to own SpaceX stock. You won't vote on it. You won't be asked. The mechanics of passive investing will simply buy it for you automatically. Insiders get liquid. Passive funds and retail accounts absorb shares at peak valuation. The float multiplier props up the price during the critical early window, and the 3-month price discovery period that used to protect buyers, gone. This is the whole thing. And here's what pisses me off about how it's being covered. SpaceX goes public at $1.75 trillion is a headline. It's clickable. It gets engagement. NASDAQ quietly rewrote its float weighting methodology to engineer passive fund demand for a company losing $5 billion annually, right before the largest IPO in history. That doesn't trend on Twitter. That requires patience and more than 30 seconds of attention span. So it doesn't get covered, and most Americans walk into it completely blind. That's exactly the gap
Finance misfires.
exists to fill. Not the headline, the mechanics underneath it. The rule changes nobody explained. The manufactured demand nobody named. The exit liquidity nobody warned you about until it was already your problem. If this landed, drop a like, leave a comment. Do you think the NASDAQ rule change was written for SpaceX specifically? Or is that giving them too much credit? Share this with someone whose retirement account is about to become a buyer, whether they know it or not. Subscribe to
Finance misfires.
for more breakdowns like this. The financial system failures and money psychology traps hiding inside the stories everyone else is covering wrong. I'm Jimmy. Passive investing was sold as the smart play. Nobody mentioned you'd also be buying whatever squeezes its way into the index. I'll see you in the next one.